Hello, good morning. I am Avnish Jain. Welcome to the monthly outlook on debt markets from Canara Robeco. As usual, let's start with the geopolitics. The war in the Middle East escalated as Iran directly attacked Israel with over 100 missiles. Earlier, Iran was working through proxies like Hezbollah to attack Israel. However, this time they targeted Israel directly from Iran. This led to froth in the oil markets as people expected that Israel will attack Iran and its oil facilities. However, last week when Israel attacked Iran, they primarily targeted military installations and strategic targets. This led to some relief in the oil markets, and oil prices, which had climbed to almost $80 a barrel, have now come to closer to $70 a barrel. The war in the Middle East is unlikely to end soon, as Israel is not ready to reach any kind of settlement on the issue of Gaza Strip. They want that the Palestinians return all the hostages taken during the raid last year, and they want to ensure that this thing does not happen again. On the other end, they are also dealing with Hezbollah in Lebanon, and Israel has been fighting on two ends of Israel. The Ukrainian war seems to have gone in the background, but it still continues. So that is another hot geopolitical hotspot which is there in the region. Overall, the markets have been little immune to now these attacks, and generally we have seen markets on the upswing. Either it is equity markets or debt markets have been behaving as if everything was normal. Coming to macroeconomic parameters, we saw US cut rates by 50 basis in September. Also, in October, we saw ECB cut rates by 25 basis points. However, the data in US came stronger than expected, where the labor data also showed a surprising upswing, while inflation also remained flat with the upward bias. This led to market participants again pricing a lower pace of rate cuts from the US Fed. Earlier, after the first rate cut in September, markets expected Fed to cut another 75 basis points in November and December. Now markets expect probably a 25 basis rate cut in each of the meetings in November and December. This led to sharp reversal in US 10-year yields. The 10-year yields, which had seen a low of about 3.6%, have now climbed to around 4.30%. That's a sharp reversal from what was market conditions earlier. There is also an expectation that Fed may move much slower on rate cuts if the data continues to remain strong on labor or inflation does not move as anticipated. Coming to Indian macro, growth remains sturdy. Inflation, which was falling in July and August to 3.65, which we saw in August, September number came much higher at 5.5. While RBI had moved to neutral stance in October policy, the expectation started rising that the next rate cut or the first rate cut from RBI may come in December. However, with the higher inflation in September at 5.5%, and also now the October inflation also is expected to be on the similar level, it may be difficult for RBI to move, though in the policy meeting and in the press conference, the RBI governor had indicated that they might look through these high numbers simply because these are driven more by food prices. And with normal monsoon, the food prices should come down in the ensuing months, especially in November-December period. From that angle, there is still a good probability of rate easing by RBI in the December policy. One also has to remember December policy will be after November policy of Fed, where Fed is likely to cut by 25 basis points. Another important factor for markets is the US election slated for November 5, with the result expected to come out by November 6, unless the election results are very close. This is the much anticipated clash between Trump and Harris, and considering the recent polls where they have been running neck to neck, it is likely to go down the wire. If Trump comes back to power as president of the US, there is expectation that via tax cuts and social spending, he is likely to increase the fiscal deficit to much higher level. This is likely to lead to higher US rates, which may impact global markets. This may impact Indian US yields as well. So overall, this election, the US presidential election, is extremely important for all markets. Indian markets also reacted to the developments in the US market, especially on the yields. Because of the sharp upturn in the yields in US, Indian yields also retraced some of the fall, and from about 6.70 in September, we saw yields climb to about 6.85 currently. However, this is not a very large movement, and overall we remain positive on Indian debt markets. We believe that RBI is likely to cut rates soon, and there is a good probability of a rate move in December policy. However, RBI will be wary of higher inflation in September and October and may wait for more data before they cut rates, which would likely put the rate cut into the February policy. However, we believe that the next step would be easing, and that is positive for rate markets. We expect that market yields to fall down over the next 6 to 12 months as RBI cuts rates, and we also see global easing happening simultaneously. Growth numbers, while they have been steady, there is some moderation in growth numbers, especially when we look at auto sales, two-wheeler sales, and other high-frequency data. That should also give some ammunition to RBI to look at rate easing. In terms of funds, we are constructive on the short end of the curve, especially the 1 and 2 year bucket. This bucket has been consistently on the higher side in terms of yields as compared to the rest of the curve. This gives good option to investors to look at short end of the curve and invest in funds like ultra short term fund, low duration fund, and short duration fund to take likely advantage of movement in yields in the coming months. As usual, investors should look at their risk return profile and their investment horizons before investing in mutual funds. Thank you, and wishing happy Diwali to all our investors.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.